So one of the biggest reasons for a big rally in Indian markets is its superior growth. In fact, not only that, Asia overall, parts of Asia are doing very well, and India is shining right now within that pack. The view coming from Morgan Stanley is that Indonesia could be the economies where could adopt rate hikes by mid of next year, and with the first ones. So we thought of getting you a special voice today. We have Chetan Ahya, Chief Asia Economist at Morgan Stanley, joining us now from Hong Kong. Chetan, so good to see you. Thanks for your time this afternoon. Very engaging note that you've come out with, but the part of the note which has excited the street most is the rate cut talk, which you speak about in your note. Indonesia could be the ones to lead. Talk to us about the factors which could trigger that. Would the rate cuts here lag US rate cuts, or it could happen ahead of that as well?
It would be more or less coincidental, and the argument that we are putting forward is the fact that inflation in Asia has actually not been that intense. It was largely driven by high commodity prices and to some extent currency depreciation. And now, to the extent to which commodity prices have come down, we don't see the same kind of depreciation pressures. You are going to see that the inflation trajectory will look very comfortable. In fact, as you already know, inflation in India has come back within central bank's comfort zone. And for about 78% of region, we've seen that inflation has come back within central bank's comfort zone. So inflation is coming down and real interest rates are rising. As such, we think that central banks can cut rates now, but they will hold back until late second quarter next year to wait for the Fed to give clear signals that they are now going to also begin to think about cutting rates. So that's the approach that we're taking when we're making the call for rate cuts somewhere in June next year.
Okay, so expecting rate cuts to happen in June next year in India. But I also wanted to discuss the growth assumptions with you. You, of course, have an assumption of over 6% growth for India. But do you think that is largely driven by urban consumption and discretionary spends itself and not as much from rural India? Or do you think even that part of the economy is kicking and firing away now?
So I think our premise is essentially that growth is going to broaden out. We are seeing already early signs of consumption pickup, broadening out from urban to rural. And at the same time, as far as investment cycle is concerned, we've seen the lead from public side. And then now going forward, we're expecting the private capex line also to join that recovery. So it's going to be more broad-based recovery going forward. And that's sort of the approach that we're taking when we are making the call for GDP growth to be at 6.5% next year.
Chetan, what are your thoughts on the effect of a rate cut, beginning of the rate cut cycle, whenever it does next year, on corporate India's balance sheets? Because on the one hand, traditional wisdom said that lower rates or the rate cut cycle actually completely starts revaluing the equity landscape on the one hand, and also helps the balance sheets reduce their debt burden. But the debt levels of corporate India in general are pretty low right now. They've been going down last few years. So how do you assess the impact?
So we think the impact will be modest because we're not really expecting a big rate cut cycle. We're only expecting about a 50 basis points reduction by the RBI. So it's a shallow rate cut cycle. It's not really critical for India's recovery, but it will help to further enhance that private capex recovery that I was talking about. And that will be the positive effect of those rate cuts.
Chetan, what about the impact of elections? How do you read this event panning out for Indian growth as well as the overall economy?
So elections are going to be critical because we think that one of the key drivers for India growth story that we are forecasting to be quite healthy at 6.5% is that improvement in private investment. And in fact, the overall investment to GDP in India has inflected upwards after seeing almost a steady decline since F 2013. We've seen that it's now bottomed out, and we've seen a nice pickup in the investment to GDP trajectory. And so that trajectory will need a stable government at the center. So in case you get a weak coalition government, that may affect the corporate confidence and the private investment recovery that I highlighted earlier. So we are watching elections for from the continuity of the policy as well as the stability of the overall government and its impact on the private investment trend.
Chetan, I want to talk a little more about the quality of capex which is happening front-loaded by the government and triggered by the government. Now, early signs, some say, are in private sector as well. Just over this weekend, we are talking about 1.4 lakh crore worth of fresh defense-related program being spoken about. Prime Minister, in regular conversations like Man Ki Baat, etc., also talking about, or at least indicating to massive consumer buying in the festive season. How do you see the ingredients of the economy right now, like capex, like big ticket consumption, waves?
So we think that initially the recovery was because of reopening, and you had a dynamic where macro stability indicators in India were good, corporate sector had delevered, the banking system had cleaned up its book. So you had a nice cyclical recovery in domestic demand. And then now we have entered into the next stage of recovery where it's not just about operating leverage. If you think from a corporate sector perspective, it's now going to be about a pickup in investment cycle, which will then make it more sustainable in terms of the growth trajectory. And so in our thinking, we are most focused on private investment improvement. After that, public capex recovery, that was the first part of the investment cycle that took off. And consumption will follow, but from a growth sustainability perspective, and when you're thinking about India now, most investors are getting attracted to India because of the long-term growth outlook. And to fulfill that long-term growth expectation, it's really the capex cycle that has to take off. So yeah, I think if you ask me, the details of our thinking about India's outlook, the most important one is private investment pickup.
Chetan, when you speak to a lot of funds across in your circular and your client community as well, is there a comparison being drawn with China? China's appeal as an investment destination, good long-term patient money, reducing. Is that kind of money also incrementally looking at India now because of these factors which you laid down for us?
Well, I think India's story has been there independently of China. And so in that sense, investors are looking at India more independently. Yes, there has been some diversification that investors are having to make in their portfolio. And in that context, India has benefited. But if you saw what happened in 2022 and even in second half of 2021, when China was going through problems, there was a sell-off in Indian markets too by the foreign investors. So it's not like as if it's the money that went out of China came to India. I think India is being viewed independently. And for foreign investors, the biggest concern that they have on India is valuations. They do agree with the fundamental story being great, but to the extent to which we have this sort of strong domestic inflows and the domestic investors have been also buying, that's keeping the markets a bit more expensive, and so they are more worried about valuations. And in that sense, India's story has been evaluated independently of China.
One last question, Chetan. Because I'm asking this question to you on behalf of a lot of market participants, is there risk to policy momentum? The general narrative is that in continuation of the current leadership, policy momentum only gets stronger, will continue at least. Any aberration, it could get a jolt. Is that a fair risk to the overall kind of argument on growth?
sorry, which context you're
So this
talking
context
about?
is in the general elections in mid next
Right.
year. If there is an aberration to the continuity narrative which the market is going with right now, is that a risk we should price in our investment thesis and overall approach?
So, I mean, I'm not the strategist, so I wouldn't comment on what should be the pricing of the market. But from a macro standpoint, as I mentioned earlier, yes, that is an important risk that we are watching. And the way we are sort of caveating that risk is that you want to see that there is a government which is looking more stable. It can be a coalition government, but it should be more stable coalition versus a weak coalition environment where the lead party has not enough seats to hold together a coalition which is going to be able to implement on the long-term strategies to revive private investment and give that continuity of policy to the corporate sector.
Okay, Chetan, thanks so much for making time and speaking with us. So regarding a whole host of issues, right from elections, Indian economy, inflation, rate cuts and all of that, appreciate you making time.
My pleasure to be with you guys.